Welcome to the latest edition of our monthly market update. The last few weeks have been particularly eventful. Most major equity indices are flat or negative year to date, thanks in large part to the ongoing war in Ukraine. The war has raised inflation expectations and dented growth projections. However, March saw a recovery for some equity markets. Inflation is still the main focus for financial markets, with geopolitical issues adding to already high energy and food prices. The Federal Reserve and the Bank of England both raised rates last month, as expected. The respective tones were, however, slightly different, with the Fed adopting a more hawkish tone than the Bank of England. Fed Chair Jerome Powell stressed that the US economy was performing well and the labour market, which is usually a good indicator of the health of an economic cycle, was strong. Job openings in the US are at a 10-year high. The Bank of England went with a slightly more cautious narrative, highlighting a fear that inflation would damage consumer spending in the coming months. There is a concern that bolder rate increases could send the economy into a recessionary spiral. In the European Union, inflation is more linked to supply than demand, with energy prices in particular driving up costs. The ECB, however, seems determined to raise rates at least once before the end of the year. The key question is whether Christine Lagarde, the European Central Bank President, is ready to backtrack in the event of a deterioration in economic conditions. The fixed income space has been the most affected by the change in rhetoric from central banks, having one of its worst quarters in living memory. Remarkably, the yield curve for some US Treasuries inverted, with 10-year bonds recording lower rates than 2-year bonds. On paper, this signal can be taken badly, often signalling a coming recession. The equity market has, however, largely ignored it. This may be due to the fact that high inflation expectations have already been priced in the short term, and this will normalise over time. If we look at the real, inflation-adjusted rates, the yield curve is in fact not inverted. The big question is whether or not bond valuations have bottomed out, and if portfolios will enjoy some sort of uplift from rebalancing into fixed income. This will largely depend on inflation. In the meantime, our exposure to commodities, Chinese government bonds and inflation-linked bonds is helping to offset negative equity performance. On the upside, equity markets seem to have largely shaken off the geopolitical uncertainty. Some major equity indexes have delivered a positive performance, particularly in the US. The macroeconomic fundamentals seem robust. First of all, real rates remain low, a sign of expansionary financial conditions. Secondly, macroeconomic data does not yet suggest a significant slowdown in the business cycle. Finally, looking at expected corporate profitability, we can see that companies are benefiting from higher revenues brought by increasing prices. In terms of equities, we'd argue that starting valuations today look better than the recent past, and this is good news for long-term investors. The risk to earnings is also probably greater, especially in Europe. We believe that this is a case for cautious positioning. Our recent rebalance reflected this, but we are wary of being too conservative. We continue to favour greater equity exposure in the US rather than in Europe. However, again due to low real rates, equities continue to represent a better opportunity than bonds, and our outlook over both the medium and the long term remains positive for equities. Finally, it's worth taking a look at China. The last month or so has been turbulent, with fresh surges of COVID-19 causing uncertainty. Chinese equities have, however, underperformed for some time despite Beijing's increasing role in the global economy. There are a number of factors to consider here, from the tug of war between government and big tech to the excessive debt in the real estate sector. We have talked in detail about them in a deep dive article you'll find as a part of this market update. From our perspective, we stick to our view that now is not the time to add to Chinese equity exposure, despite attractive valuations. We're also happy with our exposure to government bonds, which have consistently offered decent returns and remain a good avenue for diversification. Thank you for watching. As usual, if you want to discuss market conditions in more detail or have specific questions about your portfolio, please book an appointment using the link below or contact the team by phone, chat or app.